Okay, so we talked about part one, which is war, part two, which is peace, and now we'll talk about part three, which is putting all the pieces together, understanding why VC is relevant and what it means. And so the richest family in America was the Rockefellers. As you know, they owned Exxon, right? They had a VC division called Venrock. And Venrock invested in a company in the 60s called Fairchild Semiconductor. And the reason they did was because Sputnik, or the Russian satellite, beat America to space. And so America were brokenhearted during the early 1960s. And so the Kennedy administration decided to create NASA, which is awesome. And then NASA basically wanted to get the first person on the moon before the Russians did. It was a national pride issue. And they couldn't do it because they couldn't fit 100,000 little transistors or chips into the fuselage or top part of a rocket. And so what happened was NASA financed this company called Fairchild. And Fairchild figured it out. And these are called the Traitorous Eights, these heroes. They founded Fairchild Semiconductor, and they did it. They figured out how to put many transistors into the top part of a rocket. And as a result, America beat Russia to the moon. And it was a big point of national pride for America at that time. And then, so what happened was, as with all great companies, they get too big and bureaucratic when the founders leave, right? And they can't innovate anymore. And this happens to all big companies, right? And so Fairchild got too big, right? And remember at the beginning of each chapter or class, I have that chart. And on the y-axis, I have small company, medium company, too big company. Fairchild got too big. And therefore, they couldn't innovate anymore, which was tragic, right? And so it became bureaucratic, and many people quit. And many people quit, and a lot of Fair Children companies were born, and they were backed by venture capital firms. A couple examples of those chip companies include AMD, NVIDIA, and of course Intel. All those companies came out of Fairchild. Right? And so the semiconductor sector was very vibrant in the Bay Area. And then the hardware sector kicked ass with companies like HP. And then software around that like Oracle and all these other great firms. And then the internet sector, Google, Facebook, etc. You get it. But the point here I'm trying to make, and this is relevant to the rest of this course I'm teaching, is that very big companies where the founders have left can no longer innovate. Why? Because if you're an executive at a large company and the founder leaves, the founder wanted to change the world. The rest of the executives just care about climbing the corporate ladder, and politics sets in. And so these executives climb the ladder. All they care about is trying to get to the top because they get paid more. And the second they try to innovate or step out of line to innovate, if they're not successful, they're done, man. They're not climbing the corporate ladder anymore. And if they are successful, they're not going to get paid anyway. Why? Because nobody wants to disrupt the whole corporate pay structure in a big bureaucracy where the founder is no longer there. So the incentive is to leave, start a company, and get funded by high net worth investors, angel investors, seed investors, or venture capitalists, which is the core part of this course. Okay, and the same thing happened with Hewlett-Packard. It got too big and bureaucratic, and it just got broken up recently, and many HP children came out of that firm. And in the internet space here in the Valley, the PayPal mafia runs the Valley today. And what does that mean, Chris? Well, PayPal is the most important company to go public in the past 20 years. Yeah, controversial, I know. More important than Google, more important than Facebook, more important than any of those other companies, because PayPal went public and was the first successful IPO after 9/11. And then more importantly, what happened was a lot of amazing executives came out of PayPal. And they came out of PayPal and started their own companies. And I'll give you examples. The founder of LinkedIn worked at PayPal. His name was Reid Hoffman. The founder of Tesla and SpaceX worked at LinkedIn. Worked at PayPal. Of course, he's Elon Musk. The founder of Yelp came from there. The founder of YouTube came from PayPal, etc. So we call that the PayPal mafia. And I mention that story because I wanted to reinforce the importance of betting on a strong management team that's had a past exit, okay? And the PayPal mafia, they had a fantastic exit, and they've been incredibly successful. And so Many other companies that I haven't even talked about came out of that out of PayPal, including Clarium. Peter Thiel, of course, runs Clarium. He's probably one of the best investors on the planet. And other firms like Yammer, etc. And so venture capital firms love backing the same executives again, because the probability, again, of you making money by investing in somebody that's already been successful and has already had exits is higher than those that have not. Okay. And so basically the top venture capital firms get all of the great deals. It's just how it works. The top 10 firms or so are the most relevant. It's hard to compete. It really is. And so Kleiner Perkins, a great company, they invested in Twitter, Lending Club, Nest, Waze, etc. And you recognize a lot of those brands. Other companies include Sequoia. So Sequoia is incredible. It's the best venture capital firm here in the Bay Area. And check this next slide out, how they really emphasize the founders of these companies and not the underlying companies as much. It's actually brilliant. So here's Sequoia. And so you can see Apple is highlighted there. There's Steve Wozniak and Steve Jobs. A lot of other great companies are highlighted there. And so ideas are commodities, execution is not. We've talked about that before. Most venture capital in America is in the Bay Area. Now, the sector is extraordinarily cyclical. You tend to only get good exits every 10 years or so. And valuations are a little bit stretched right now. Although I will say that, although external events tend to burst bubbles like black swan events like 9/11 or Lehman Brothers going belly up, it's not as bad this cycle, only because we have a more robust internet infrastructure where the cost to start a company is much lower today, and broadband penetration is truly ubiquitous now versus the 90s. But valuations are stretched. I have to be intellectually honest with you. And so I mentioned before how a lot of engineers and founders in the Valley are born overseas. In fact, 60% of engineers in the Valley are born overseas, and they come here. And there's a whole notion of, if you want to be an actor, move to Hollywood or Bollywood. If you want to be working in technology, move to whatever. So, and I'm not saying Silicon Valley is the only place in the world where technology companies can prosper. Certainly not the case. But it's interesting to study the environment, what made them successful here. So a lot of dreamers come here, a lot of dreampreneurs. I love it. There's really a sense of optimism, and there's no limits to what you can accomplish here in the Bay Area. And it all started up because of war and peace and the hippie movement, and that took 50 years to develop. And so, other regions of the world that try to develop a commensurate infrastructure, you can't do it overnight. It takes a long time, right? There's got to be a cultural movement, a government-sponsored movement as well, and then the rebels. Here's to the crazy ones, that sort of thing. Watch that video on YouTube. Here's to the crazy ones by Steve Jobs. And so, people just think very big here. Again, it feels a little bit like 1999 today, but not nearly as egregious. And it's worth repeating this from Warren Buffett. I love this quote. He said, "Be fearful when others are greedy, and greedy when others are fearful." And basically, all that means is buy low, sell high. That sort of thing. So there's a reason why they call him the sage of Omaha. You want to be a contrarian when it comes to investing always. And I even tell that with my children. They love collecting baseball cards like I did when I was a kid. And I tell them, you want to buy the best baseball cards when nobody wants them, and you want to sell all of them when everybody wants them. So let's move on to talk about what kind of venture capital firm should you target if you're trying to raise money. Well, you want to know their stage focus, right? If they're early stage, meaning A or B, then you're an earlier stage company, approach them. If the firm is later stage, like C or D, or sometimes E, late stage, then approach them. Don't approach investors that have no shot of investing in your company because of a different stage focus philosophy. Know their sector focus too. Obviously, don't approach a hardware-based venture capital firm if you're starting a software company, or don't approach a restaurant or hotels-based venture capital firm if you're starting an industrial firm. Okay. Know their reputation as well. I can't stress this enough. You never, ever want to do business with anybody in life that's incredibly abrasive, or has an awful reputation because this cannot be undone. Once they invest in you, they're on your board, and they're disturbers, they're activists. Make sure you know their reputations well, and really understand their target return on investment date as well. If your company is not going to be profitable or go public for 8 to 10 years, make sure the venture capital firm understands that, so they think along your lines, along the same lines as you do. So just make sure you know their target return date. And are they founder friendly? There's a reason why Peter Thiel's, who's the first investor in Facebook, Peter Thiel's venture capital firm is called Founders Fund. They back founders, right? So make sure the venture capital firm you're dealing with hasn't fired a ton of founders. Myself, when I sit on boards of companies or charities for that matter, I always see myself as kind of a prosthetic extension of the management team. I'm here to help. I'm here to facilitate. And if I can't help you during board meetings, I just shut up, right? If I can introduce you to customers, I'll do that. But I'll never tell you how to run your company because you know better than I do. I will give advice if you ask, though. And so you want to only partner with venture capital firms that are somewhat founder-friendly. Okay, are they growth or value? And I want to stress this because you have to understand in business, investors, it's very philosophical, and it's almost like religious warfare between the different investment sections or groups. You're either a growth investor or a value investor. What does that mean? Growth investor wants to invest in companies that are growing fast, and growth investors don't care about valuation today. They care about valuation in 5 years, which is my philosophy. Not saying I'm right, I'm just different. On the other end of the spectrum is value investors. And those are people, like Warren Buffett, who's a great investor, but they only buy companies if they're cheap today, trading below book value, meaning if you liquidated all the assets and liabilities, you'd have more money than what the company's valued at today. Value investors are not good at investing in tech companies. Growth investors are. Make sure you understand where you are on that spectrum if you're an investor as well. And it takes a long time to know what you are. When I was younger, I was a value investor. I couldn't understand why certain stocks traded at 100 times earnings. And then I transitioned to being a growth investor, which most venture capitalists are. Okay, do you enjoy the companies of the venture capitalists that you might partner with? This is really important, really important. Why? Because you're going to be spending a lot of time with them. And unfortunately, sometimes more time with them than your family members. So do you enjoy their company? And life's too short to do business with jerks. So pick your VCs and other investors and business partners in general in life wisely. Do you trust them? Right? And if your gut is from your first meeting, from your first 20 or 30 minutes of meeting with them, you don't trust them, go with your gut. Your gut's often right. Okay, great. So how do venture capital firms make money? We cover this. 2% management fee. I want to emphasize it again. 2% annual fee they get, right? And then they get 20% incentive fee. So again, if you start a company, it costs $100, or you invest $100 in a VC firm, and then it's a 10-bagger, so it's worth $1,000. You get $800. They keep 20%. So it's called 2 and 20. Similar to hedge fund, yeah. VC legal paperwork. Okay, so venture capital firms can only have accredited or high net worth investors investing in a VC firm. They give what's called an offering memorandum, which is just legal documents that everyone has to read or at least receive before they can invest. And I'll talk about that with the IPO process later, and I promise you it won't be boring legalese. Okay, so how does investing in venture capital in general work? Well, if you invest in a venture capital firm, right, say you give $100 to a VC firm, or you tell them you want to invest $100, they're not going to ask for $100 up front. In fact, you usually don't give much at all. What? Well, what happens is you get called. They call you for that capital call, when they need it. I'll give you an example. Let's say I started a VC fund, and you want to invest $100 with me, and you fill in all the paperwork and you sign. Cool, thank you. What happens next is if I see a great investment, like say Palantir, and I want to put 10% of my fund, the venture capital fund, in Palantir, right? So I'll put $10 in. I'll call you and I'll say, hey, I need to get 10% of your investment to put in Palantir. Okay, and I'll keep calling you and calling you and calling you until all the money is gone, except we leave about 20% left over, right? So we invest 80% of the fund, right, and say, 8 to 10 ideas. We have about 20% of the money left over to avoid dilution. What does that mean? We'll go through a lot of details on this later, but it basically means if somebody else invests in the company other than us at a higher valuation, we want to invest part of the 20% we have left over so we don't get diluted. Okay, so we still own the same percent of the company, right? We'll cover that later, don't worry. Okay, so how do venture capital firms get deals? Network. Did I say network? Relationships, and I've stressed this so much, it's so damn important. Relationships are more important than product knowledge, and we get the best deals by networking, right? And I find that, finding the best deals, if something is given to you, if somebody approaches you and gives you an investment opportunity, and you didn't have to fight for it, it might not be worth it. In fact, please do this. If somebody offers you the investment or the opportunity to invest in a company, public or private, I want you to ask yourself this. Why am I so lucky to be seeing this opportunity? Why am I so lucky to be getting this opportunity to invest? I want you to be skeptical, okay? Because more often than not, nobody else would invest, right? And so you might be the last person. Just be skeptical as well. Always ask why. Okay, so venture capital firms love to back the same management teams over and over again. There's this weird element in venture capital of co-opetition, which I've never seen in any other industry. What I mean by co-opetition is we cooperate with other venture capital firms because, let's say we do the A round at my firm. My friends that work at another firm might do the B round, right? That sort of thing. But I compete against all venture capital firms to get the A round, right? So it's this eclectic mix of firms competing and cooperating. Okay, great. So you can also get great ideas from universities. Like John Doerr from Kleiner Perkins, I think he got access to Google because he walked up and down the halls at Stanford, where Larry and Sergey started their company. Okay, so how do VC firms do due diligence? They do pretty in-depth background checks on the management team. They also size up the total addressable market. They analyze the competitive market environment as well. So there's a company I'm on the board of where before my partners would agree, and all of us agree to invest in this company, I had to write literally a 412-page due diligence report. And that report had the font size of 80. I'm just kidding. No, it was font size 12. But I really had to analyze the management team to death, every single employee. And I used LinkedIn for that. And I called my friends that knew people that knew those people. See, I had a network like crazy. And other ways I did due diligence was I sized up the market, the total addressable market, and I created a pretty in-depth financial model. And we're going to go into a lot of detail later on how to create income statement, balance sheet, cash flow statement, but the fun way. Don't worry, and don't let the math get to your head. It's actually pretty easy. I'll teach you that later. And so each deal has one lead investor, and other venture capital firms invest with them, just to kind of diversify the risks. There's a lot of money, or a lot of money at risk here. And my father, who's a very successful business person, he'll never deal with just one bank. He'll deal with many because you want to keep them in check, right? You want them to compete for your business to give you the best rates. Okay, so we're now going to talk about preferred shares and harvesting of assets. Okay, so what kind of firms do we back in venture capital? Again, I like to back strong management teams. It's okay if they fail before. That's cool. But as long as they're good, they're competent, they've had an exit, or have a good board of advisors. You also want to invest only in companies that have a massive TAM, or total addressable market, of at least $20 billion. You want a strong syndicate, meaning the other investors before you are very high quality investors, right? So they've done their due diligence too. And you want to, of course, invest in a disruptive business model, which is going to change the world.